Well, welcome back to Financial Accounting 1. And I brought along, for purpose of this little bit extra, my friend Mr. Spock from the original Star Trek. Thank you, Mr. Spock. I have him sit over here. You might want to Google Spock, S-P-O-C-K, and see what I'm talking about. Role was made famous by Leonard Nimoy. Purpose of this exercise is not only to get to see Mr. Spock, but I want to review slowly with you, and in neater handwriting than when I do it in class, the in-class exercises that we did. And these in-class exercises are a good way of studying for the exam as well. It's coming up. So I'm going to share my screen. Hopefully it's the right screen. And here we go. So we've got, this one has to do with the aging of accounts receivable. So remember, if we have accounts receivable, we are going to have, not if, we know we're going to have accounts receivable that are going to prove to be uncollectible. And those accounts receivable that prove to be uncollectible, we're going to have to recognize something called bad debts expense. And there's two ways of recognizing bad debts expense. One is the direct write-off. So when an individual account receivable goes bad, we simply debit bad debts expense and we credit accounts receivable. That gets the accounts receivable off the books and recognizes the expense. But we remember from my riveting lecture that that is nice and simple and is often used by small businesses for tax purposes, but it is not acceptable for generally accepted accounting principles, GAAP, G-A-A-P. It's not acceptable for GAAP. GAAP requires us to do some estimate of the accounts receivable, to estimate in advance what portion of them are going to prove to be uncollectible, and to achieve better matching of revenues and expenses. So if you're going to recognize credit sales, then in the same period of time you recognize credit sales, you need to recognize the expense based on experience associated with some of those sales on account proven to be uncollectible. So here is an incomplete aging schedule. So these are the current accounts receivable you see here on the left. And those accounts receivable are stratified by whether they're current or whether they're overdue. So you get 168,000 and they fall into these various groups. Experience tells us that those accounts that are still current, 1% of those will prove to be uncollectible. And as we move further out in time, we find a higher percentage of the accounts will prove to be uncollectible. So it says, prepare the adjusting entry to recognize bad debts expense. Well, there's two steps to this. First, you have to figure out what the total estimate is of the stuff that's going to prove to be uncollectible. So if you multiply 120,000 by 1%, 20,000 by 3%, 10,000 by 6%, and so forth, what you're going to come up with is $6,000. You can check that yourself if you haven't done it. So that's my estimate of the amount that's going to prove to be uncollectible is $6,000. So you've got to make an entry to bring the balance of allowance for doubtful accounts, which is a contra asset account, which means it has a credit balance. You got to bring that up to $6,000. So you might be tempted to say, oh, that's simple. I'm going to debit bad debts expense, $6,000. I'm going to credit allowance for doubtful accounts. You've got to always look at what the balance in the allowance for doubtful accounts is before you make the entry. And it says here, Milena Company had a credit balance of $700 in allowance for doubtful accounts. So if you want to bring it up to $6,000, the amount of the additional bad debts expense is not $6,000, it's $5,300. So you debit bad debts expense $5,300, and you credit allowance for doubtful accounts. See, it's $6,000 minus the $700 that was already there. Where did the $6,000 come from? So you multiply these things out. So you take 120 times 1%, 20,000 times 3%, blah, blah, blah. You add those all up to equal $6,000. Okay, so that's part A. Part B, assume the same facts, but the allowance for doubtful accounts has a debit balance of $500. So remember, you think of the T account, allowance for doubtful accounts, and on the debit side, you got 5,000. And after you make your adjusting entry, you got to get it up to 6,000. So the amount of the expense has got to be large enough to offset the 500 that's already there on the debit side and to bring it up to $6,000. So the combined amount, so it's 6,000 plus 500. So you debit bad debts expense, credit allowance for doubtful accounts, right? Journal entries, they're never going to go away. So be familiar with these journal entries, be able to make these journal entries for recognizing bad debts expense. Next exercise has to do with notes receivable. So we get a note receivable in three ways. We could have a note receivable as a result of lending money to someone, in which case we debit note receivable, we credit cash. We could have a note receivable in exchange for a sale. So it's a big ticket item. So rather than selling the stuff on account, we make the person who bought the stuff sign a note. So we debit note receivable, credit sales. Or it could be a case where we have an account receivable that had previously been account receivable. Maybe the terms were 210-30, and after 30 days, the guy hasn't paid us, and we send our 800-pound gorilla over there to collect the money, and he says, "Look, I can't pay you now." And the 800-pound gorilla says, "Well, can we get you to sign this note with some exorbitant rate of interest?" So if you can satisfy an account receivable by issuing a note receivable. So there are three possibilities. So let's take a look at what happened here. So here are the entries. And for the first part is pretty simple. So first, you've got to, on November 1st, on December 11th, and on December 16th, you've got to record these various notes. For the time being, don't worry about how long they are and what the interest rate is and so forth. So first one, loans $24,000 cash to Simone Buell, sounds like it's French. So that's simply a debit to note receivable and a credit to cash. So that's loaning someone in exchange for $24,000 in cash, they sign a note. So we increase the account note receivable by credit cash. On the 11th of December, sold goods to Dak Joe Inc., receiving $12,000 90-day note. So here it was a note receivable given in exchange for a sale. So I debit note receivable, I credit sales. And on the 16th, received an $18,000 6-month 8% note in exchange from Jason Tanner's outstanding accounts receivable. So in this case, the person had an accounts receivable. They didn't satisfy the account in time. We followed up with them, and we agreed to accept a note into settlement of the account receivable. So it's a debit to note receivable and a credit to accounts receivable. So you see in these three transactions here, examples of the three different ways that we could get a note. So on the November 1st, we made a loan. December 11th, we sold merchandise. And on December 16th, I had an account receivable, which was transformed into a note receivable. Those are the three possibilities. Now we got to play around with all the interest rates here. So it says accrue the interest as on all the notes receivable as of December 31st. So let's assume our year ends at December 31st. All of these notes, given when they were made, are actually, we're not going to collect on these notes until the next year. But there is interest on this one earned since November, on this one for the next 20 days in December, for this one for the next 15 days in December. So you've got to actually accrue the interest. So the way to get the accrued interest is you take the Buell note, which was 24,007%. That one was dated November 1st. So that's 2 months or 2/12. Joe's note is dated December 11th. So that's an additional 20 days in December. So 20 divided by 360. You've got 3% interest. That gives us $20. And then Tanner's note is dated the 16th. So there's only 15 more days left in the month. That's at 8%. So 18,000 times 8% multiplied by 15 over 360. So the total accrued interest there is $360. Remember this from Chapter 4, accruals and deferrals. An accrual, you accrue a revenue in advance. You recoup a revenue before it is received. So I'm not going to receive the interest till later on, but $360 worth of this interest was earned in 2020. If I fail to make the accrual, then this $360 interest is going to show up in the next year where it was actually earned in 2020. So I debit interest receivable and I credit interest revenue. Okay. And then B, journalize the collection of the Buell note at maturity in 2021. So this was a $24,000 note. And this was a note that paid 7%. So we've already got 2 months worth of interest at $280. So the amount of interest that we would get in the following year would be the additional, it's a 12-month note. We've already accounted for 2 months in 2020. So in 2021, it's 24,000 times 7% times 10, 12. So the amount of interest that is earned in 2021 is 1,400. The face amount of the note is 24,000. And you had set up an interest receivable. This $360 here included $280 for Buell. So you're going to reduce the interest receivable by $280. So that's the journal entry to record the actual collection, not of all the notes, but of that particular note. So when you collected the $25,680, there's your debit to cash. Your credit to notes receivable is the face amount of the note. The 280 is the interest that had been earned in the previous year, which I had accrued, which you see right here. And then the additional interest was for 10 months at 7%. That's your 14. All right, so that's that. And the last one, this one has to do with testing your knowledge of accounts receivable. By way of a review here, what I would recommend you do, answer these questions, at least part A, compute the ending balance of accounts receivable. So I would suggest you set up a little T account here. So I'm going to set up a little T. I think I could annotate here. Look at that, I got new powers. Okay. And it says, had accounts receivable of 150,000. So we start with 150. I got to warn you here, my handwriting is going to be awful. So that's 150,000 on the debit side. I'll get better as time goes on. The only transactions that affected accounts receivable during 2020 were net credit sales of 1,500,000. So when you sell stuff on account, you debit the notes, you debit accounts receivable. So that is 1,500,000. Okay. And collections of 1,400,000. So during the year, you collected 1,400,000. So that would be a credit. 1,000,004. I got empathy now for stroke victims. Okay. So what is the balance of accounts receivable right now? Well, it had been 150. So let's see here. Okay, stop with the annotations. Okay, there we go. So I could have done it actually more neatly here. So there's how you set it up as a T account. So if you just set it up as pluses or minus, remember this is accounts receivable. Okay, accounts receivable. I'll turn off the annotation here. All right, so looking down the bottom here, it's 150 plus the 1,500,000 minus the 1,004,000. And also you had a write-offs there of $50,000. I ran out of space to write it there. So when you wrote off 50,000, that would be another credit here. So you come up with a balance in ending accounts receivable of $200,000. That's your balance at the end of the period. So that was A. B, compute the accounts receivable turnover. Well, accounts receivable turnover would be the credit sales, which in this case we had credit sales of 1,500,000. So that's my numerator, divided by the average accounts receivable. So you had accounts receivable at the beginning of the period, 150, account receivable at the end of 200. So add those up and divide by 2. So I think that's 175,000. So 1,005,000 divided by the 175 gives you the 8.57. So that's your turnover. That's the number of times we collect accounts receivable during the year. And if you want to get the average age of the accounts receivable, you take 365 and divide by the turnover. So it takes us on average 42.6 days to collect accounts receivable. Okay. So I hope you found that little review useful. What I'm also going to do is I'm going to post the practice exam for you, and I'll give you some instructions on that. And if you haven't done so already, make sure you get caught up with your homework, particularly the homework that's going to be on this coming exam, which I believe is chapters 5, 6, 8, and 9. We skipped chapter 7. So good luck, everybody. Talk to you again soon. And Spock out. See you later.